Welcome to the Deep Dive, your shortcut to understanding what's really driving the market. Today we're breaking down the Q2 2025 earnings call for Magnachip. They held it after market close, July 31st. Now, this company's in the middle of a pretty big shift, trying to become purely a power semiconductor player. And if you caught the action right after the news dropped, you probably saw the stock, well, take a bit of a nosedive.
Yeah, it was noticeable.
Definitely. It seemed weird to some because the headline results actually looked, well, pretty decent. So that's what we're digging into today. Why the sharp reaction? What did the market really hear beyond those initial numbers?
It's a classic earnings puzzle, isn't it? Because you're right. At first glance, Magnachip seemed to deliver. I mean, GAAP EPS came in at a positive cent. The consensus was looking for, what, negative 13 cents? Huge beat there.
Right. And the non-GAAP, the adjusted EPS.
That was negative 8 cents, also much better than the negative 13 cents expected. So yeah, beats on both counts.
And revenue too, right?
Yeah.
That wasn't a miss.
No, revenue actually topped estimates as well. Came in at $47.6 million versus the $47.2 million consensus. That's 8.1% growth year over year from their continuing operations. Pretty solid.
Plus, gross margin landed at 20.4%, which was right inside their guidance range.
Exact.
So, okay. Beat, margin in line. But the stock tanks almost 13% right away. That tells you the market's looking somewhere else, especially with a company in transition like this. It's often more about the road ahead than where they just were.
Precisely. That immediate drop screamed, we're looking past Q2. Investors were digging into the underlying stuff, the trends, and crucially, the outlook management gave.
Sure.
You often find the real story in that gap between the reported numbers and the market reaction. It means it's not just about the spreadsheet figures. It's about the narrative, the guidance, the strategies.
Okay, so let's get into that deeper dive. The financials, the operations, what was really going on under the hood? You mentioned the Q2 revenue growth, 5 straight quarters year over year. Sounds good. But management flagged something interesting.
They did. They mentioned that some customer orders were actually pulled in from the second half of the year into Q2.
Ah, okay. So not necessarily new demand, just accelerated demand.
Right. Driven largely by customers worried about potential tariffs, that kind of uncertainty. So it makes the Q2 number look good, but maybe steals a bit from Q3 or Q4. And that, along with other things, put some real pressure on the gross margin.
Yeah, I saw that. Down 70 basis points year over year. What was driving that?
They pointed to a couple of things. One was an unfavorable product mix. The other, and this is a big one, was aggressive ASP erosion, average selling price.
Meaning they're having to cut prices.
Yeah, essentially. Selling products for less, especially the older generation stuff in China where competition is, well, fierce.
Okay.
And there was also a sequential margin dip, partly from inventory reserves and, yeah, those pull-ins we just talked about. Shifting revenue around can sometimes compress margins too.
Got it. So connect that to the bottom line, profitability, cash flow. How did that look?
Well, it definitely gets a bit cloudier there. Adjusted EBITDA was actually negative $2.1 million, and the GAAP operating loss was $7.4 million. Now, hold on, you might say, didn't GAAP EPS look good at positive 0.23 cents?
Yeah, that's confusing.
It is until you see why. It was massively boosted by a $10.8 million non-cash gain from foreign currency fluctuation.
Ah, okay, not an operational gain then.
Exactly. If you strip that out and look at the non-GAAP diluted loss per share, which was negative $0.08, that gives you a much clearer picture of their actual operating profitability or lack thereof.
Right. And what about cash? Was that holding up?
Cash took a pretty significant hit too, dropped from about $133 million down to $113 million in the quarter.
Wow, where'd it go?
Mainly two big things. $11.9 million in capital expenditures, which is, investment, and about $6.5 million in one-time costs tied to shutting down that old display business.
Okay, so some strategic spending and some cleanup costs.
Pretty much. But what's interesting, maybe even a sign of confidence, is that even with cash going down, they kept buying back stock.
Really?
Yeah, repurchased 0.7 million shares for $2.3 million. It's like management saying, look, we think the stock's cheap even while we're investing.
Okay. And that display business shutdown, is that done?
Almost. They said it's nearly complete, and they actually expect to get about $20 million in cash back over the next couple of years.
Wow.
From selling off the last bits of end-of-life product and monetizing the intellectual property, the IP, from that old segment. So it's been a drain, but there's some recovery expected, just gradually.
Okay. Let's talk about those investments, the CapEx. You said $11.9 billion went out, mostly for the Coomi fab.
Yeah, a big chunk is for upgrading their Coomi fabrication plant. They actually upped the expected full-year CapEx now to $34 million. Of that, $22 million is earmarked specifically for Coomi.
That's a lot of spending for a company burning cash.
It is, but here's the kicker. They said 85% of that Coomi investment is funded by a low-interest equipment loan, like under 3% interest.
Okay, that helps.
Yeah, it cushions the blow, and this spending is crucial for their strategy. It's meant to enable the new generation products, which should hopefully boost gross margins down the line. Plus, the depreciation from this new equipment won't actually hit their financials until 2027, so it's definitely a long-term investment.
Right. And are they doing anything on the cost side, the operating expenses?
They are. They announced a voluntary headcount reduction program. Should be done by the end of Q3. They're targeting about $2 to $3 million in annual OPEX savings from that.
Okay, so trying to trim costs while investing for the future. That makes sense.
Yeah, trying to find that balance, get some operating leverage eventually.
So let's tie this all together now. The financials, the spending. How does it fit into their big strategic picture, this pure play, power, semi-transformation?
Well, they're definitely pushing hard on that front. The product pipeline looks active. They launched 28 new generation power analog solutions, or PAS products, just in Q2.
28? Wow.
Yeah, and they're aiming for over 50 new ones by the end of this year.
That's a rapid pace. Are they getting traction with customers? Design wins.
Seems like it. They reported 71 total design wins in Q2. That's up 61% year over year.
Okay, strong growth.
And importantly, about a third, 32% of those wins were for the new products. That's key. These new designs are targeting those higher value markets, automotive, industrial, AI applications, places where they can hopefully get better margins.
Right. Move up the food chain.
Exactly. Management's projecting these new segments will be over 60% of their product mix by 2028. That's the goal anyway.
Any specific areas doing well right now?
They highlighted strength in communications. That's phones, tablets, smartwatches, and also computing. So PC power, AI servers. PAS revenue in those spots grew like 47% year over year.
Impressive. And the tech itself. What are these new products?
They're focusing on things like their Gen 6 superjunction MOSFETs, also low-voltage Gen 8 parts. These are aimed at niches like EVs and LED lighting where power efficiency really matters.
So higher performance, higher value applications.
That's the idea. Trying to shift away from the older, more commoditized stuff that's facing that price pressure we talked about.
When do these new products actually start moving the needle financially?
They expect some initial revenue maybe by year end, but the real significant impact, management said that's more likely in the second half of 2026. So still a ways off.
Okay, that's important context. There's a vision, but it takes time. They reiterated that 3-3-3 strategy too, didn't they?
They did. $300 million in revenue, 30% gross margin in 3 years. That's still the target they're talking about.
And here's maybe where the market got nervous. They also admitted it's getting tougher to hit that right now.
Yeah, that's exactly right. They basically said, look, the goal is still the goal, but macro factors are making it challenging currently. That China for China strategy, which is important long term, is facing headwinds now from tariff uncertainty and that ongoing price pressure on the older products.
And that led directly to the guidance cut, which seems to be the main reason for the stock drop.
Absolutely. That was the bombshell, really. They revised the full year 2025 guidance. Revenue now expected to be flattish year over year.
Ouch. That's down from mid to high single-digit growth they were guiding before.
Big downgrade. And they also lowered the gross margin guidance to 19-20%, down from 19.5, 21.5%.
So a softer second half is officially expected now.
Yes. And that outlook, that caution for the rest of this year, that's what the market latched onto. It completely overshadowed the Q2 beats. It told investors the near-term path is bumpy.
Yeah, the market wants proof. Show me the turnaround. Don't just tell me about the long-term vision.
Exactly. And even with the new products coming, the fact that they're still burning free cash flow, that operating leverage isn't ticking in yet, and margins slipped, it just highlights the execution risks. Investors are going to watch that very closely.
Right. So that nearly 13% drop makes more sense now. The market basically ignored Q2 and priced in the weaker full-year forecast.
Pretty much. And it's not just Magnachip feeling this, is it? You see it across the industry. Power semi companies have great long-term trends like EVs and industrial stuff, but they're also battling price erosion on older nodes, tough competition in China, trade policy jitters. A lot of their peers are guiding cautiously too.
Yeah. Makes sense. And Magnachip's stock itself has lagged, hasn't it?
Massively. Down about 42% over the past year, while the semiconductor ETF, SMH, is up like 45%. Huge divergence.
Wow.
This call really highlighted that gap. Management painting a picture of long-term transformation with the 333 goal and new products versus the market laser-focused on the immediate softness and execution questions.
What do the analysts think? You see price targets still suggesting upside.
Yeah, the median target on the street is around $6, which implies, decent upside from where it fell. But clearly the market sentiment right now is driven by the headwinds, not the target prices.
So what should people be watching for? What are the key catalysts that could change the narrative?
Okay, a few things. First, obviously, Q3 results in late October. We need to see if things stabilize or if the guidance gets tweaked again.
Right.
Second, really critical, are the customer qualifications for those new Gen 8 MOSFETs. That needs to happen in the second half of this year to keep the 2026 revenue story on track.
Okay.
Third, any movement on U.S.-China trade talks, a reduction in tariffs or even just less uncertainty could really help.
Good point.
And finally, don't forget the M&A angle. There was noise about strategic interest earlier in the year. As they become a more focused power semi company, could that chatter resurface? It's always a possibility.
The path forward really depends on them stopping that margin slide and actually turning those design wins into real profitable revenue.
That's the bottom line. Execution is key.
Okay, now for our segment. This is not financial advice, where we float an idea that might sound a bit out there, maybe even audacious, but based on what we've heard, maybe plausible.
Right, let's hear it. After that drop, finding something audacious but plausible.
Well, given how hard the stock got hit and this split between the ugly near term and the potentially bright long term, how about this? Thinking about a long position.
Whoa, okay. Long after a 13% drop on guidance cuts. Bold. How would you structure that? Not just buying shares, I assume.
No, probably not just buying and holding for a slow recovery. More specific. Maybe using options, buying out of the money calls, say, expiring in Q1 2026, targeting strikes maybe around $5 or $6.
Okay, Q1 2026 calls. That gives it some time. What's the core thesis behind that, though? Why bet against the current market sentiment?
The thesis is basically that the market has overpunished the stock for near-term issues that management specifically linked to uncertainty and price pressure on old products.
Right, while they're actively pivoting.
Exactly. They're shedding the legacy display stuff. They're ramping these new-gen power products. They're investing heavily in Coomi with financing help. The real story, the value proposition management is selling, is that 333 goal and the new products.
Which have better margins and are expected to really hit stride in the second half of 2026.
Right. And even those Q2 pull-ins, while messy for margins now, hint that some underlying demand was there, just shifted due to external stuff.
Okay, I see the logic. Betting that the market's too focused on the next 2 quarters and ignoring the potential inflection point later. But what makes it outrageous but plausible? What could trigger a rapid shift?
That's the key. It's not a bet on a slow grind higher. It's a bet on catalysts hitting sooner than expected or having a bigger impact. You've got that cost-cutting program finishing by end of Q3, saving $2-3 million a year. You've got the $20 million cash inflow coming from the display IP over time. Those help shore up the financials.
Okay.
Then imagine if M&A talk heats up again as they become a cleaner, pure play asset. Or, crucially, what if those Gen 8 MOSFET qualifications happen successfully by year-end and they announce some major customer wins?
So if one of those hits...
Exactly. If just one of those catalysts lands especially strong product news or M&A buzz, the market's short-term funk could evaporate fast. Sentiment could pivot really quickly toward that longer-term, higher-margin story.
So it's a catalyst-driven bet. You're not buying the dip hoping it recovers slowly. You're buying the potential for a rapid re-rating triggered by specific events, possibly amplified by M&A.
Precisely. Outrageous. Maybe. Plausible if the catalysts line up. Potentially.
Definitely food for thought.
So, wrapping up, this Magnachip call was really a tale of 2 completely different stories, wasn't it? On one hand, you had decent Q2 numbers, solid execution in some areas, and this really promising long-term strategic shift happening.
Yeah, the transformation story's there.
But on the other hand, completely overshadowed by a cautious near-term outlook, driven by those macro headwinds, especially the China pricing and tariff stuff. It just hammered home that future potential often matters more than past performance during a turnaround.
The big question for anyone looking at this is, Did the market overreact to the short-term static? Is it missing the bigger picture? Or is the path to actually delivering consistent profits and growth still too foggy, too uncertain to really buy into yet, despite the new tech?
Yeah. The next few quarters are going to be critical for showing which narrative wins out. Definitely worth digging deeper into their strategy and keeping a close eye on those catalysts that we talked about.
Absolutely. Thanks for joining us on The Deep Dive.